Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ALBERTSONS Companies INC quarterly report. ALBERTSONS Companies Inc. offers a wide range of businesses and services through its subsidiaries. The company's primary offerings include grocery products, general merchandise, health and beauty care products, pharmacy, services, fuel stations, food manufacturing and processing, in-store pharmacies, branded coffee shops, digital platforms. The company operates under various banners, including Albertsons, Safeway, Vons, and others. Its services also include distribution centers, manufacturing facilities, and fuel centers. The recent surge in Albertsons Companies, Inc. stock price can be attributed to several key factors that emerged during its second quarter fiscal year 2025 earnings report. The company's robust financial results, including a higher-than-expected earnings per share and revenue exceeding analyst forecasts, led to a significant increase in the stock price. Additionally, Albertsons raised its full-year guidance, indicating management's confidence in continued growth, and expanded its share buyback program by $750 million. Strong growth in digital sales, pharmacy sales, and an increased loyalty program membership also contributed to the positive sentiment among investors. These developments collectively drove a notable surge in the stock price, with shares rising over 12% during midday trading on October 14. The primary drivers of revenue growth or decline are largely influenced by various segments within the company's operations. On one hand, digital sales have seen a significant increase of 23%, while identical sales excluding fuel have grown by 2.2%. Additionally, pharmacy sales have experienced strong growth, and retail segment sales have shown an upward trend, reaching $43.37 billion in 2025. On the other hand, revenue decline has been observed in certain areas. Net sales and other revenue decreased by 6.3% for the first 28 weeks of fiscal 2025 compared to the same period in fiscal 2024. Fuel sales revenue also saw a decline of 16.1%, amounting to minus $361 million. Furthermore, fresh produce, meat, deli, and prepared foods revenue decreased by 0.8%. These contrasting trends highlight the mixed performance of different segments within the company's operations. Net income experienced a significant increase of 15% from $145.5 million to $168.5 million for the 12 weeks ended September 6, 2025. However, this growth slowed down to a 5% increase from $386.2 million to $404.9 million over the 28-week period. In contrast, profit margins saw a decline in gross margin rate from 27.6% to 27% for the 12 weeks ended September 6, 2025. The reasons behind these changes are multifaceted. A decrease in gross margin rate and increased loss on property dispositions and impairment losses contributed to the decline in profit margins. Additionally, fluctuations in the price of goods sold and cost of goods used in food products, as well as supply chain challenges, further impacted net income and profit margins. These factors collectively influenced the changes in net income and profit margins, highlighting the complexities of managing a business amidst various market and operational pressures. The company is generating significant positive operating cash flow, with net cash provided by operating activities reaching $2,489.3 million in 2025 and $2,217.9 million in 2024. This indicates a consistent trend of generating more than enough cash to cover operational expenses, positioning the company for long-term financial stability. The company's debt level has undergone significant fluctuations over the past year. Initially, long-term debt decreased from $7,762.5 million to $6,940.1 million, indicating a reduction of approximately $822 million. However, this trend was later reversed with an increase in debt level by $275 million, bringing it up to $600 million. Regarding interest expenses, the data is somewhat inconsistent across different pages. Nevertheless, based on the most clear and consistent information, it appears that interest expenses have not changed significantly overall. In some periods, such as Q2 FY25, interest expense increased to $105.3 million compared to $103.6 million in Q2 FY24. Conversely, in other periods like the first 28 weeks of FY25, Interest expense decreased by $2.2 million from $249.3 million in fiscal 2024 to $247.1 million in fiscal 2025. Management is emphasizing a long-term growth strategy centered on technology, driven by the customers for life approach. This involves investing in digital platforms such as e-commerce, loyalty, pharmacy and health, and mobile app to drive customer engagement and growth. The company aims to balance future investments with returns to shareholders through dividends and share repurchases, while prioritizing innovation, efficiency, and cost savings through a cloud-native platform. The company has made significant transactions through acquisitions and divestitures. Notably, it entered into a merger agreement with Kroger, marking a major acquisition. On the other hand, the company has also engaged in divestitures, including the sale of real estate assets which generated gains, as well as the disposal of certain technology assets, resulting in losses. The company's financial summary reveals that it has engaged in two key shareholder return initiatives. Firstly, the company has a history of paying dividends to its shareholders, as evident from references on pages 3, 37, and 38. Secondly, the company has also bought back shares, with supporting evidence found on pages 11, 28, and 38. These actions demonstrate the company's commitment to rewarding its investors through both cash distributions and share repurchases. Concerns about inventory buildup and supply chain disruption. The financial summary highlights several red flags that indicate potential issues with inventory buildup and supply chain disruption. The increase in LIFO expense, higher merchandise costs, and challenges with the supply chain all point to a possible problem. Furthermore, the decrease in adjusted EBITDA due to changes in working capital related to inventory and receivables suggests that these concerns are having a direct impact on the company's bottom line. These issues may indicate a need for the company to reassess its inventory management and supply chain strategies to mitigate potential disruptions and costs. That concludes the financial summary for ALBERTSONS Companies Inc. Feel free to comment below, and I will be happy to answer them when possible.